For millions of small business owners across Indonesia, the clock was ticking, and time was officially running out. Under the existing tax law, the popular 0.5% final tax rate on gross revenue came with a hard expiration date. This was the definitive rule of the land. Signed into law in December 2022, the mandate locked the nation's MSMEs onto a strict, unavoidable countdown. It represented a major push by the previous administration to formalize the economy and move small businesses into the standard tax system. The problem is, formal accounting requires significant resources. For everyday vendors in local markets, this mandate was a compliance hurdle they weren't prepared to clear. To address this widespread compliance gap, the government pivoted by releasing a new set of rules. To provide relief, they officially issued Peraturan Pemerintah No. 20 of 2026. This move by the current administration steps in to modify the existing trajectory, giving millions of businesses room to adjust. PP 20 functions as a targeted amendment, extending the timeline for specific entities while keeping the underlying bookkeeping requirements of the original law in place. So you need to figure out exactly where you stand. Did your specific business just get a tax extension? And if you did, how should you strategically use this temporary grace period before the inevitable deadline hits? We need to look at how this breaks down by entity type. Let's start with individual taxpayers, or WPOP. If you operate as a solo entrepreneur, the original law gave you 7 years to use the 0.5% rate. For many of you, that clock officially ran out at the end of 2024. The new regulation changes that, granting an extension to keep using that final tax rate through the 2025 and 2026 tax years. You can see it right here in the text. The final tax status remains valid for these individuals through 2025 and 2026. This provides immediate cash flow relief and saves you from paying accounting fees today. But remember, you are pushing the compliance wall down the road to 2027. Now, let's look at the second major group, the single-member company, or PT Perorangan. Your timeline was originally set to end in 2025. This new regulation moves that deadline back, extending your eligibility through the 2026 tax year. The document confirms this directly right below, securing the extension for the PT Perorangan through 2026. For both of these groups, the reality is the same. You keep your low barrier to entry for a bit longer. However, because the simplified tax is calculated on your gross turnover, you remain locked out of claiming standard corporate deductions. If your operating costs are high, you eat those expenses yourself. Finally, let's examine the rules for cooperatives, or cooperati. If your cooperative was registered before this new regulation took effect, your timeline to use the simplified tax rate was scheduled to expire between 2024 and 2029. The amendment grants these cooperatives an extension to keep utilizing the 0.5% rate from 2025 all the way up to 2029, depending on exactly when you registered. The text explicitly outlines this 2025 to 2029 window specifically for cooperatives. But there is a strict limitation attached to this benefit. You must track your income closely to ensure your gross turnover never breaches the 4.8 billion rupiah threshold. Cooperatives receive long-term stability here, yet an unexpected turnover spike crossing that line triggers an instant revocation of this tax privilege. While the timeline extensions dominate the headlines, there is an additional compliance mechanism built directly into this new law. Historically, some businesses have attempted to classify unofficial fees, bribes, or gratifications as legitimate operational expenses, aiming to lower their taxable income on paper. This new regulation addresses that practice directly. It introduces a brand new section, Pasal 20A, which forbids claiming these payouts as deductions. The legal language is unmistakable. Expenditures in the form of bribes, gratifications, or any similar payments are denied. The rule applies broadly. It explicitly states that even payments made to foreign public officials cannot be written off as a business expense. The operational trade-off here is quite stark. If a business operates in an industry that relies on these types of unofficial payments to function, their tax burden will increase because those costs must now be paid with after-tax money. The government has paired these extended timelines with a demand for clean internal audits, completely free of shadow expenses. Ultimately, this amendment recognizes that the jump to full corporate bookkeeping is difficult for small businesses. It offers up to 24 months to figure it out. To capitalize on this grace period, you need a transition plan right now. You must audit your turnover, select reliable accounting software, and thoroughly review your deductions to ensure they comply with the new rules. This extension is ideal for profitable bootstrappers who currently have messy back-office operations. If that's you, you can use these 24 months to clean house without facing immediate tax penalties. On the flip side, some businesses should consider opting out of this lifeline. If you operate with very tight margins, paying 0.5% on your gross revenue can be more expensive than paying the standard corporate tax on a tiny net profit. The government has provided a temporary grace period for building financial infrastructure, rather than a permanent tax break. If you reach January 2027 without a functioning profit and loss statement, this lifeline will have been wasted.